So higher for longer continues to be the narrative here, right? We started off with the March of this year, traders thinking we're going to get some rate cuts there. That was not true. We had Powell come out, throw cold water on that. Traders thought, okay, maybe May. Now that was also thrown cold water on. Maybe June, right? And now the probability of a June rate hike is also diminishing and diminishing and diminishing further. We've got traders out there that are now pricing in that it's possible that we could just see maybe one rate cut, right? And the idea of a June rate cut is very unlikely, so it could be either September or at the end of the year, December. But what happened? What has changed? Bond yields started to go up. The stock market's a little bit in panic mode, not on the geopolitical tensions. That has somewhat of an effect. But if you look at the bond market, there are bigger signals there that are signaling to the stock market and the rest of the markets out there. If you look at the correlations, the inter and intra-market correlations, you can see there is a bigger worry other than this war, the situation between Israel and Iran. And that situation, that issue, is the inflation issue. So we had Fed Barkins come out today. We had Fed Powell come out today. Other members of the FOMC also. But I'm going to highlight some key points here. Fed Barkin came out, said that CPI data has not been supportive of a soft landing. All right? So, the CPI data that we're seeing, like I've been saying for quite some time on this channel, we're seeing that stickiness there. It's going to be tough to bring that down. And what do we all of a sudden think that rate cuts are going to solve all of this? Not really. And if you go in further, Fed Barkin also says the economy is not overheating, but if so, we can deal with it. Which basically means, what does it mean to deal with it? To hike further? To continue to be higher for longer? Right? And also, Fed Barkin says it's smart for the Fed to take its time on the decision to cut rates. So again, pushing back on the narrative of, we're going to get rate cuts very soon. Doesn't seem like it. We also had Fed Powell come out and basically say the performance of the U.S. has been quite strong. The economy's been quite strong in America if you look at the data. The U.S. economy over the past year has really been quite strong. Recent data, now here's the key point here. Very important line, listen to this. Recent data show lack of further progress on inflation. Let's repeat that. Recent data show lack of further progress on inflation. Basically telling you there that they've been looking at the inflation data for a very long time. Last year, this year, right? January, February, March, April. We still got more data. Basically saying that the progress is not really there of what they want to see. Which means that those rate cuts that everyone's thinking about, don't think it's going to come very soon. Moving forward, Powell also said labor market moving into a better balance even amid ongoing strength. Powell also says that the core PCE inflation was little change in March according to estimates. So again, the stickiness in the inflation, like I've been saying, it's sticking around. If you look at the shelter component, sticking around there, right? Powell says if higher inflation persists, the Fed can maintain current rate as long as needed. So if this inflation persists, or even inflation goes up higher, right? Don't think that, okay, you're going to get those rate cuts very soon. In fact, that you might get this pause for the whole year is also a possibility. That's definitely a possibility. Now, the U.S. short-term interest rate futures dropped after the Fed chair said a couple of things. After Fed Chair Powell says restrictive policy needs further time to work, saying that the tightening that they have done it still hasn't done the job. It needs more work, right? So the interest rate futures, the short-term futures, are basically expecting that the Fed to cut rates more, not more than once this year, right? So very likely that we could go from the market's pricing in, more than 3 rate cuts, even though Fed told us 3 rate cuts, to down to now 2, to down to 1, right? Because of this inflation that's sticking around. Now, to add a whole wrench in all of this, right, the war situation that's happening, that can definitely create upward pressure in oil, in prices, in the CPI report, which would hence then bring in higher for longer narrative from the Fed, right? Especially if the economy continues to be strong. So if that's the case, and we see oil hitting $100 a barrel, or even going further than that, higher and higher, then why should you think any rate cuts to come this year? In fact, possibility that discussions of rate hikes could come back on the table if prices get too crazy, right? Too ahead of themselves. Now, there's this whole idea that also that when they cut rates, right, if they do one rate cut, that it's going to solve a lot of things, especially when it comes to mortgages, mortgage renewals, and all of that. That's not necessarily true as well. If you get the rate cuts happening, right, and you got the higher for longer narrative still going on, you can still have long end bond yields moving up higher, or staying higher, or maybe not moving down as much, versus the short end, creating some sort of steepening, which hence would still not make much of a change or move in those mortgage rates, right, for getting a house, or when it comes to renewals. Even if they do 3 rate cuts, 4 rate cuts, right? Let's just say they go with 3 rate cuts this year, or 2 rate cuts. It's still not going to change the needle. You can still expect mortgage rates to be high up there because of those longer end bond yields. That's another thing that not a lot of people are talking about. Maybe I'll do a separate video on this, right? So in the 90s, we had a situation like that, where rate cuts interest rates were high, and as there were some rate cuts being implemented, though the mortgage rates didn't really budge, didn't really move, right? You still had higher mortgage rates. Definitely, you could see that same scenario here, hence making it harder for people to renew or to go out and purchase a home, and so on, right? Affecting the real estate market, the demand for real estate out there. So let's play the scenario that there's no black swan event, no massive recession, nothing crazy happens, no crash, jobs are fine, economy's fine. Then guess what? You got rates that are up higher. Let's say you get a rate cut 2, 3, right? You get some rate cuts a little bit in, let's say, early of next year. Let's just say, hypothetically. Inflation's not coming down. And then what, right? War escalates, oil prices go up, they keep rates steady for some time. Those bond yields, which we're seeing right now on the long end, which is close to October 2023 highs, could continue to go up higher or even make new highs. That's a possibility, right? And if that's the case, then you could get a scenario of just stagnant growth, and inflation also being stagnant as well as those mortgage rates being at that level for, who knows, 5 years, 6 years, 7 years, if it's really truly soft landing and we don't get any black swan event. Okay, so if there is a black swan event, sure, definitely things will change very rapidly, very fast, and that will really bring inflation down. But if that's not the case, then, and you're expecting that the economy is going to be fine, then keep another scenario in mind, that as the economy is fine and still plugging along, inflation is not coming down, right? Then expect 5 years of just, 5 or maybe even, could be close to 10 years of just sideways, and, people just sitting on the sidelines or waiting or hoping or, crossing their fingers, getting advice that let's get a variable rate and so on, because we know rates are going to come down. But, you can expect that rates will probably not come down and stay higher for longer, right? And people to be more frustrated with the real estate market because of the mortgage yields just staying where it is, because of the stickiness, because of the higher for longer mantra, and the bond yields on the long end staying up higher, right? So these geopolitical tensions, the risk of war, etc., supply chain being disrupted, whatever the case may be, if that continues to escalate, then that's going to make the Fed's job even tougher. Thus, forget about any hopes or dreams or ideas of some sort of rate cuts, okay? So it's funny how things have transitioned, because I remember countless of time, people on TikTok and all that coming out saying, get a variable very fast, or, do this, do that. I bet you when those rate cuts come, the property markets are just going to shoot up, and you won't be able to get a home. Better to get it now. Rates are going to come down. It's going to go back to zero. Well, that may not be necessarily true. Sure, prices may move up. The stock market can still move up, depending on real estate. We'll see what happens, but let's just say, real estate may stay elevated, may stay where it is, may move up, right? The fact of the matter is those interest rates are not going to budge until the inflation does, until it comes down. So, sorry to pop anyone's bubble, but that's the reality, and that's not what I'm saying. That's what Fed Powell is saying, and that's what short-term interest rate futures are pricing in now, saying that the Fed's thinking about 3 rate cuts. I don't think so. 2 or 1. And now you've got, markets thinking 1. Of course, this can all change very fast, right? We still got many more months till the end of the year. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers, and bye.